Okay, welcome everyone to our now quarterly webinars. For those of you that have been to a few of these, I think we started out at weekly when COVID first hit 18 months ago or whatever it was now. And from then, I think we went back to monthly and now we're at quarterly because, well, up until recently, we thought we'd seen the worst of the whole COVID thing. And it'd become more of an economic update. Obviously now things have changed a bit again and we're all in lockdown, and I don't know about the rest of you, but I'm not overly optimistic we'll be out by the end of the week, but fingers crossed I'm wrong. But I suspect we might be in for a little bit longer yet. But yeah, anyway, we'll jump in here. As I said to those that were on before, I've popped you all on mute for now. If you have any questions, you can either pop them in the chat box, or at the end I'll unmute everyone and you can fire away then. Okay, so what we're doing today, just a bit of an update about where share markets, etc. are at the moment. And then I just want to look at where to from here. So for those of you that have seen sessions that I've done before, I like to present a positive and a negative case, because at the end of the day, we've got our opinions of where it's going to go, but there's always a contrary opinion as well. So I prefer to present both. I think we're looking quite good for where we're going, but I'd like to present the negative opinion as well, because look, we never know. None of us has got a crystal ball. So we'll do that. And then at the end, as I said, we'll open up for questions. Should only last probably about half an hour, maybe even a little bit less. I was saying to Mitzi before that I don't think Gil's coming onto this one, so that might make it a bit shorter. But yeah, if you've got any questions, put them in the chat box, or we'll open it up at the end. If you're having trouble hearing me, just try turning your video off. I know it sounds stupid, but sometimes it's an issue just with the internet and it can't handle video and sound. So try that again and let me know if you're having troubles. And we're recording all of this, so we can either email that to you or it'll be uploaded on our website in the coming few days. And again, if you want any of the slides, let us know. My slides are fairly basic though. I'll just talk around the points that I've got there. So a bit of an update. As most of you are probably aware, we've had a fantastic recovery since COVID. The last 12 months, what we're seeing typically with most of your portfolios is returns 15 to 25%, depending on how your money's been allocated. And just the last quarter, we've seen the Australian market, so the quarter ending in June, we saw the Australian market up 8.5%. Since then, we've seen a little bit more of a rise as well. So we're seeing the Australian market at record highs or close to it basically every day, and the US very similar. So it's been an amazing recovery from where we were 18 months ago. Australian unemployment is down to 4.9%, so that's the lowest in a decade. So it's well and truly lower than it was pre-COVID. It's back to the levels it was sort of post-GFC, and it's arguably starting to get close to full employment. We don't really have a great definition of what full employment is. And you might look at it and think, well, full employment should be an unemployment rate of 0. But there's always going to be people that don't particularly want to work, or fairly transient workers. So we're always going to have some sort of underlying unemployment rate. There's an argument that it's somewhere around 4 to 5% is full employment, which is what the government's really aiming for at the moment. And we'll talk a little bit more about that later. US inflation figures are up to 5%, and Australia is something similar. The core inflation figure, which is a slightly smoothed figure, is a bit lower. I think US was about 3.8, 3.6, somewhere around there. But it's still significantly higher than it's been for a very long time. And that's one of the things that central banks around the world are keeping a close eye on, is the inflation rates. In the US, their job recovery has been strong, similar to ours. So their unemployment rate's down to about 5.4. Some economists over there are predicting that their unemployment rate's going to be in the low 4% by the end of this year. Obviously, that's dependent on how things go over there with COVID as well. So they've still got areas in not so much lockdown, but limitations on things. So there's some unemployment caused by that. And there's the expectation that by the end of the year that we'll see most of that gone. Obviously, that depends, like it does everywhere, on the spread of COVID and the uptake of vaccines and everything along those lines. Okay, where to from here? So we, as an office here, are all quite positive about what we're going to see for the next 12 months to 2 years. So it's fairly easy to present that positive case, but I'm going to present a negative case at the end as well. Maybe I should have done it the other way around. I should have left it on a high at the end, but for whatever reason, I've done positive first. So the positive case is that at the moment we're seeing share markets largely unaffected by what's happening with COVID. So we're seeing this Delta strain that's in Australia now. We're seeing that across the world. We've seen it in the US, in China, obviously causing great problems here. But interestingly, it hasn't had any impact on share markets at the moment. What we saw initially with COVID was, obviously when it hit, we saw big impacts on the share market. Since then, markets have largely ignored changes in cases because it's assumed that governments know how to handle this now, and that we've been through lockdowns and that we've come out largely unscathed. So the rise in cases hasn't caused us any problems to date. I've touched on that already, that there's a lot of confidence in the government's ability and their willingness to manage the impacts of any lockdowns or anything along those lines. So we saw with the initial cases, governments around the world decided that they had to lock things down, but at the same time, they realised that to keep the economy going, they had to introduce stimulus. They had to print money, lower interest rates, do all of those things that have kept the economy going. In Australia, that meant that we had JobKeeper through the worst of the lockdown, and now they've introduced something that looks fairly similar to it, although from everything we're hearing, it's probably not as easy to access, and having a lot of businesses and individuals struggling a little bit getting that payment as quickly as they could under JobKeeper. But still, it again gives the financial markets a lot of confidence that if things do get worse, that governments will throw money at it until it gets better. Some people have referred to it almost as a government guarantee on share markets at the moment, which is something that we've never really had before. But that's effectively what happened in the early stages of COVID, was that government said, okay, we'll do whatever we have to keep the economy going and effectively prop up these companies. And I think that guarantee still really remains, although we are seeing, we've seen it in Australia, just that little bit more reluctance in this case to introduce the same measures as we had initially. So there is still that question mark about how long governments will continue to prop things up and whether they'll step in as strongly as they did in the past. But there's still a lot of confidence that they will. Sorry, bear with me for 1 second. So yeah, the US employment has continues to exceed expectations every quarter so far, or every month. Sorry, they do their unemployment figures. Aside from I think June, they've exceeded unemployment expectations, so or employment expectations. So that's been fantastic, and it's been one of the real amazing things about this recovery is that it's constantly been exceeding expectations. Yeah, there's always been a lot of negatives out there. A lot of people saying that yeah, this recovery is going to be very slow and difficult, and we continue to exceed those expectations. And unemployment is one of those areas. You know, I remember when COVID first hit in Australia, they were talking about it being worse than the Great Depression. The increase in unemployment was faster and greater than it was during the Great Depression, and that this recovery was going to take forever. And you look now, and we're at the lowest unemployment we've seen for a decade, and that's less than 18 months on from when things first started. The other interesting thing in the US is that their earnings are actually up. So not only are more people working, they're earning more for the work that they're doing, particularly in the leisure and hospitality sector. So there's a real I guess lack of staff in the leisure and hospitality area in the US. Part of that is caused by the government. So they've increased their unemployment benefits, and for a lot of people, they've decided it's better to stay on unemployment than get a job. And so that's forced wages up in that area. But even in other sectors, we've seen an increase in earnings, which is exactly what governments are looking for. Because at the moment, what they're doing is pumping money into the economy, building up demand, but it also builds up inflation. Inflation isn't a problem as such, as long as you don't let it go for too long. So what governments are hoping to do is to have inflation build that creates jobs. We get that unemployment rate right down. That then means that we start to see wages go up because there's competition to employ good staff. Employers have actually got to offer more money to get the staff they want. That brings wages up, at which point they can start to increase interest rates without causing a big issue. The big concern that a lot of people have had is that with the debt levels that we've taken on, with interest rates as low as they are, and particularly the housing market going as crazy as it has, people have some huge loans, and the concern is always what happens when interest rates go up. And so what governments are looking for, and particularly in Australia, but across the world, they're looking for wages to go up before they start to increase interest rates. And what we're seeing is that in the US at the moment, that's starting to happen. And with the Australian unemployment rate coming down as far as it has, there's the expectation that we'll see that happen here shortly as well, in which case the government can start to put the brakes on that inflation a little bit by potentially starting to increase interest rates slowly. In Australia, they're not talking about doing that until 2024, although a lot of economists are now expecting that it might happen in 2023. It's all going to really come down to those wages. But again, there's a lot of confidence here that we are going to continue to see share markets going up, and really most of it still comes down to that second point, that we're very confident that governments are still able to and still willing to step in and support markets. Interesting part as well is that the US market have beaten their quarterly earnings forecast by 25%. So basically that's saying that companies are a lot more profitable than what they expected. And again, that's a really good sign that this recovery has been quicker and stronger than what was expected. That company profits are up significantly, or significantly more than we expected. And the good thing that means is, and this starts to get a little bit technical, that the US market's trading at about 21 times the earnings of the companies, which is not excessively high. So one of the issues that people have been concerned about is that the share market has gone ridiculously high and that the earnings aren't there to support it. And what we're seeing here is that it's trading on about 21 times earnings. The average historically is about 15, but considering the interest rates as low as they are at the moment, 21 times is actually not excessively high. You can see here in the notes, we've seen as high as 123 back in 2009. That was a huge spike around the GFC, but trading at 21 times earnings is not a concerning figure. And again, that gives us confidence that there is still room to go with markets going higher. So again, we're very positive about where things are going from here. There has been a lot of concerns about this slowdown as we see, governments start to slow down their intervention. We've seen in Australia the removal of JobKeeper and all the speculation of how horrible that was going to be. And then we saw, unemployment figures continue to drop after that was removed. Since then, obviously, we've gone into another wave of lockdowns, which is going to affect unemployment again. But the issue is not where employment goes to through the lockdowns, it's how quickly it can recover afterwards. We expect that through a lockdown that there has to be an increase in unemployment because there's certain industries that just can't trade. You can't go to a restaurant or a pub at the moment. You can get takeaway and things like that, but there's those industries that do just have to shut down through these periods, and so they can't employ people. So we are going to see those areas and that increase in unemployment. And the issue is what's going to happen after we see things open up. And previously we saw a massive drop in unemployment after things opened up, and I'm quite confident that we'll see that again. Okay, on to the negative case. So the big concern in the negative case, obviously, is the impact of the Delta strain. It's continuing to spread, and it's actually seems to be have a greater impact on people than the previous strains. So we're seeing a lot more hospitalization in the US. That's obviously a concern. We're seeing China go into lockdowns through much of their country, and obviously we're seeing in much of New South Wales and other areas of Australia struggling with it as well. Those lockdowns, the concern is that they could impact consumer confidence if we don't see governments step in as strongly as they did previously. So if you just look again at Australia, it's taken them a bit longer to step in and say, okay, we're going to give these benefits for people that have lost hours and things like that. And it's been a joint thing between federal and state governments, whereas in the previous lockdown, ScoMo got straight up and said, okay, everyone's shut down, but we're going to give you this payment straight away. And it was a lot easier to access. So we're seeing similar things in other countries where governments aren't quite as quick or quite as willing to offer as much support as they were before. And they're just trying to find that middle ground. They understand that the economy needs support, but at the same time, they don't want to be racking up massive levels of debt unless they have to. There's concern about the inflation levels that we're seeing. So I touched on the US inflation, about 5%. I think Australia, going off the top of my head, is around 4-ish. The concern is that how long central banks will be willing to accept that level of inflation. The generally accepted target around the world is between 2 and 3% on average. So they're willing to accept, some time above that and some time below that. But if we see that sustained inflation, then there's concern that central banks are going to start to increase interest rates before the economy's really ready. So what we want to see is wages starting to rise before we start to see central banks increasing those interest rates. Because if we do see those rate rises before that, the concern is that it's going to impact consumer confidence and demand, and that therefore impact business confidence. And really, the way economies work is all based on confidence. If people feel good, they feel like they've got money coming in, that things are going well, they'll go out and spend money. And then businesses can put on more staff because they're confident, and things go well from there. When people don't have that confidence, they tend to hold on to their money, they don't spend. Businesses don't put on more staff, they don't spend on machinery and things like that, buying new vehicles for staff, tools, things like that, because they're not confident that they're going to have more work coming in. So that slows down the whole economy. So what we want to see is continued consumer confidence, which is what we're seeing at the moment. But the concern is that if we have rates rising too early, that impacts that. Okay, the main things that we need to keep an eye on about to get an idea of where we are going to go from here is what the Delta strain does and if we see any future variants. So it's very likely that we're going to see future mutations of COVID. Delta is just one of the strains that we've seen so far, and it seems a lot worse than the others in terms of its spread and its impact. But that's not to say that we won't get other variants, and whether there's issues with vaccine being effective against those variants and things like that. So there's a lot to watch there. The biggest thing probably is the willingness of governments to respond with fiscal and monetary policy. So either spending money out of their budgets or dropping interest rates or printing money. We need them to continue to be willing to do that. We want to keep an eye on the rise of employment and wages. So to really see this recovery through to the end, what we need to see is those unemployment rates right down, wages starting to come up, and then we can see interest rates slowly going back to a more normal sort of level, to the point that you could actually put money in the bank and even earn a little bit on it, which would be an amazing change from where we're at the moment. The other big thing we need to keep an eye on is inflation and supply chain concerns. So one of the issues that we've got at the moment is that the prices of things are being pushed up by the fact that we can't get them. So things like a lockdown in China is slowing down manufacturing, which means there's a lot less supply of certain goods, which is driving up the prices and driving up inflation. If we see that inflation going too high, that's when the Reserve Bank starts to get worried, starts to want to increase interest rates. But again, we don't want to see that happening until we see wages starting to go up. So that's probably the main thing that I think Reserve Banks are watching at the moment. They're keeping a very close eye on inflation, but they're going to be much more willing to let that run than they probably would have been in the past. We may see inflation running at 5% for even a year or two, whereas in the past, anything above 3% and they'd start to jump on it. And the other thing we need to keep an eye on is, as interest rates do go up, which they will at some point, what does the economy do in response to that? We've seen in the past that sometimes a very small increase in interest rates can put the brakes on a lot more than central banks want. So the hope is that with some small increases in interest rates, that doesn't really put the handbrake on the economy too quickly. So yeah, that's another thing to keep an eye on. Oops, I forgot to get rid of that part in my presentation. So that's about all I had there. I'll turn on the microphones if I can figure out how to do that. Don't know how to do that. Okay. I think you're able to turn on your microphone if you want. So if anyone has any questions, you can turn on your microphone and fire them at me, or you can pop them in the chat box. Is there any questions at all? Okay, doesn't appear that we've got any questions. So thank you all for tuning in. And oh, do we have a question there? Oh. Okay. Okay, if we don't have anything at the moment, I'll leave it there. If you do have, oh wait, we've got something in the chat box. Sorry. Oh, that's just someone saying thank you. No worries, Rod. If you do have any questions later, feel free to contact your advisor and shoot him an email or give him a ring. Otherwise, thank you all for tuning in, and we'll see you all in a few months' time. Okay, thank you, everybody.